The defined benefit pension plan functions like a 10-year, $2,400,000 mortgage to yourself with a 5% projected average interest rate. This mortgage to yourself can also include a mortality gain component that pays off the balance if you die before you make all of your scheduled payments. Your spouse, children, or charity become the tax-free recipient of a maximum of $2,400,000 of mortgage equity. The maximum mortgage to yourself of $2,400,000 is available to you only if you qualify by having an average salary at some time during your career of $210,000 for any 3 years. If your average salary for any 3 years is $112,750, you would qualify for a maximum mortgage to yourself of $1,200,000. In addition, the maximum mortgage to yourself of $2,400,000 can be funded by making the amortization payments for at least 10 years. For every year less than 10 years that you make payments, the size of the mortgage available to you is reduced. For example, if you make payments for 5 years, the maximum size of the mortgage to yourself is $1,200,000. If your average salary for any 3 years is $112,750 and you make payments for 5 years, the maximum size of the mortgage to yourself is $600,000. You have the ability to reduce the amount of your mortgage to yourself by reducing your annual payments during the years when you have less earnings available to make the payments. You have the ability to begin to spend the accumulated equity in your mortgage to yourself at any age without penalties as long as the accumulated equity is distributed over 5 years or more. The investment efficiency of earnings allocated to the mortgage to yourself, your defined benefit plan, includes the 40% annual rate of return you earn immediately on any earnings that are allocated to the defined benefit plan without losses to income taxes. If you receive the same amount of your earnings in the form of compensation, you would lose approximately 40% of those earnings to federal and state income taxes before receiving the after-tax earnings to spend. In addition, the payments to the mortgage to yourself build equity by growing at a tax-deferred annual rate of return that exceeds bank CDs and Treasury bonds. Let's remember that the efficiency of the conversion of your earnings to savings is maximized by making the largest possible payments each year to your mortgage, to yourself, to your defined benefit plan. There are very few earnings and savings management planning programs available to you that can deploy earnings from your practice or business that you do not require your lifestyle cost to create an annual combined tax savings and investment growth of your retirement plan savings of more than 40%. The use of the defined benefit pension plan to fund this unique retirement mortgage to yourself maximize the efficiency, control, and safety of the conversion of your earnings that exceed your lifestyle costs to savings for retirement that, one, you cannot lose, and two, you cannot outlive. The opportunity of contributing surplus earnings to a defined benefit plan can substantially reduce your taxes and increase your savings. The adoption of a defined benefit plan or conversion of your existing profit-sharing plan to a defined benefit plan can simultaneously protect your family, increase your deductible savings, and increase your spendable retirement distributions. I am certain that a defined benefit pension plan will allow one day to lock the door, throw away the key, and enjoy your retirement. The first step in the process would be for you to contact me at my email address,